I'm Chris Orestis. I'm the president of a company called Retirement Genius. And I want to congratulate all of you for making a smart and very well-timed decision to come into what you're doing. When you look at the demographic, economic, and political reality of the aging population in this country, over the next 5 years, when we get to 2030, all the baby boomers will be 65 and above. And Gen X, right behind them. When you hear Gen X, some people think, oh, those are like the kids. The first Gen Xers started turning 60 this year, so Gen X starts turning 65 in 5 years. So your timing is great. There is such a need for what you are here to do. And to make the decision to work with an excellent organization like 21st Healthcare Consultants, they are setting you up for success at a time when it is most needed and the opportunity is maybe the biggest there's been. So you have not only the aging of the population, but there's a political reality too. More and more of the responsibility to pay for this is going to be pushed back on the individual. And that's what we're going to talk about today, is private pay, the ability of people to pay for this. When people are thinking about accessing care and they go online, which we all go online, we're all Googling stuff every day. And the two biggest things that people Google about home care and any form of long-term care for that matter is, where am I going to find it and how am I going to pay for it? Okay? And I talked to Thomas and I were talking about this last night. Think of it this way. When you go into a car dealership and you look at cars, you see the materials, you go for a test drive, at the end of all that, and you see a car you like, does the car dealership just go, well, bye, hope you come back with a checkbook tomorrow? No, they're taking you through, how do you pay for this thing? They figured that out a long time ago. In fact, car dealerships today, what they sell is financing. The car is kind of secondary to financing, you know? They're not selling you something that costs $45,000. They're selling you something that costs $375 a month. And that's kind of a mindset you want to be in, is if your strategy, and we do this everywhere. I've been doing this for 2 decades. I've actually been in this area, this space as they call it, for about 30 years. So yeah, I started when I got out of middle school. And my career actually in this world started back in Washington, D.C. I used to work in the White House. I worked on Capitol Hill for the Senate Majority Leader, and I was a lobbyist for a number of years for the insurance industry and worked a lot in long-term care. And how are we going to confront the aging baby boom population? What I told you about, they're all going to start, the last of them turned 65 in 5 years. Well, back in the day when I was in Washington, we were like, in another 15 years, they start turning 65. What are we going to do? We are like, everybody's going through the door now. And still, the critical element of this is, how do you pay for this? There's so much pressure on that piece of it, and it's overlooked. And I've seen this for years around the long-term care space, where that is sort of the like, well, I don't want to talk about that. I want to give them my brochure. I want to take them on a tour. I want to do this. I want to do that. But I don't want to talk about how you pay for it. I'm just going to hope they come back with a checkbook. And it's not. And if that's going to be your business strategy, I hope you have a nice lunch today. Because that'll be the best day of the rest of the time you do this. So what I want to talk about is not just me, but I have a colleague here as well, Tara. And over the course of the next 45 minutes-ish, we're going to talk about these private pay options. And we're going to focus on 3. There's more than 3, and I'm going to touch on them so you sort of have a good cross-section as I advance forward. But the 3 we're going to focus on are unique because they are specifically designed for seniors as they're aging and as their health is declining. And for most, when you think of financial stuff, you kind of think, well, I'm young and healthy, so I can qualify for that. But this is the reverse. This is things that quite frankly, I'm looking around the room right now and nobody in this room would qualify for. Congratulations, you're all too young, healthy, and good looking. You're not going to qualify. This is for the families that you're going to be talking to that are at the point where they need to figure out, how am I paying for this? And like, it happens fast. I don't know how many of you have ever dealt with this with loved ones, family members. I just did with my mother not that long ago. You know, it's something happened, into the hospital you go, and they wanted her out of there within 48 hours, and they're looking at us saying, so, all right, we're going to move her to a nursing home. How are you paying for it? And you know, and fortunately we're in the business, so we were prepared. But for so many people, they're like, well, wait a minute, what do you mean? Doesn't somebody pay for this? Isn't there didn't I pay for it in my taxes? Like, how did, you know? No, you did not pay for it in your taxes. And so I'm going to cover two things, and then Tara's going to cover a third. And just to set it in advance, I'm going to cover something called an LTC life settlement, and that's the use of a life insurance policy. I'm also going to touch on VA aid and attendance benefits. It's a specific veteran benefit that will help people pay for care. And then I'm going to pass things over to Tara, and she's going to talk about reverse mortgages and how they are a tool for aging in place. 3 mainstream financial options specifically designed for the families you're working for and working with. So understand that the people you're going to be working with, they have very unique financial needs based on the fact that they're aging and their health is declining. There's different stages of retirement, right? The early stage, you finally stop working and now you're going to travel and you're going to do some fun stuff, and you know, hopefully you'll be doing that. And then you sort of get to the mid stage of retirement, where you're just kind of living in it now, and then you get to the later stage where you're aging and declining, and now the fun thing is going to Walmart to pick up your prescriptions. You know, that's now what you're kind of doing. And so there's a very unique dynamic for people who get to that point where now they need care. And what we do, a thing that we have specialized in for 2 decades with Retirement Genius, is using an existing life insurance policy, cashing it out while the person who owns that policy is still alive, and letting them then use that money to pay for care. It's called an LTC life settlement. You're settling the life insurance policy. And what does that mean? It means that the owner of the policy sells their policy to a third party, to investors. There's big investment groups, hedge funds, investment banks, investment groups that will buy people's life insurance policies from them. And every year, billions of dollars of life insurance policies are bought from the original owner because it's considered to be a good investment by certain investment groups that know how to manage that right. And what happens is they will look at a person based on their age and health and pay them a percentage of the death benefit while they're alive, upfront cash, take over the premium payments. They no longer are paying premiums on the policy. And then years later, when that person passes away, that death benefit pays to the group that bought their policy. And that's how they recover the investment they made, by paying them a portion up front, paying the premiums over X number of years. This has become a multi-billion-dollar-a-year transaction, very mainstream, available in all states, regulated in all states by the insurance departments. A very mainstream insurance-based way to take a life insurance policy and turn it into something that can pay for long-term care. Now, there are certainly some very viable options to pay for care. Long-term care insurance, for example, or annuities. And you should be asking these questions. Part of your standard operating procedure when you're talking to a family should be some form of a financial analysis with them. And it can be very simple. Like, you don't have to get into it and show me a bunch of stuff. It can simply be, let's run a quick check. Let's do a quick diagnostic financially to get a feel for what you may or may not have to work with to be able to pay for this care. Do you own a long-term care insurance policy? Do you have any annuities? Do you own a life insurance policy? Are you a veteran? Do you own your home? Those are 5 immediate ways to pay for care that most people don't think of. Now, long-term care insurance if you find any clients who have long-term care insurance, that is a great source of paying for care, but you're not going to find a lot of them. Okay? There's 335 million Americans, people living in this country. There's only 7.5 million long-term care insurance policies in force in this country. Only 7.5 million. But here is another way, because life insurance, very, very widely owned across the United States. Compared to 7.5 million long-term care insurance policies, there's 260 million life insurance policies with in the neighborhood of $14 trillion of death benefit in force across those policies. What they all have in common is they are assets owned by the policy owners. When you buy a life insurance policy, that is an asset that you own. It is legally recognized as personal property owned by the policy owner. In fact, it's very similar to a home, and I'll talk about that in a second. So you have a greater amount of awareness today in the market than ever before that life insurance is something that can be used in this way. Have any of you recognized this TV ad? Have you seen on TV, particularly cable broadcasting? Wherever cable broadcasting is getting senior eyeballs, okay, there's the big 4 advertisers. The drug companies, always number 1. Medicare Advantage plans. A lot of Medicare Advantage plans. Reverse mortgages. Tom Selleck, right? He's out there talking about reverse mortgages and life settlements. Heavy rotation, all day, every day, across all cable broadcasting, Sirius XM, radio, online. This has become very well known, but still people, they know about it, but it's the opportunity now you have to put it on the table as, you know that thing about how you can use a life insurance policy? We actually have a way to do that. We can help you with that. And then that's where, working through 21st and us, you have an access now to a resource to be able to do that. And I'll talk more about how we do it. We keep it very simple for you. We do not want you getting bogged down feeling like you need to be an expert in these things. But on an annual basis, there's $4.5 billion of this being done, and a lot of it's being used to pay for long-term care. As the tagline in their advertising goes, if you own a life insurance policy that you no longer need, no longer want, you could be sitting on a gold mine. And the payouts for these can be pretty significant. I mean, remember this, when you think of a life sentence, like I said, no one in here qualifies. The bad news is the good news. None of you qualify for this because you're too young and healthy. The older and sicker somebody is, the more they're going to get from a life settlement. So if you were let's say you were like 65 and had some health impairments and a policy, and maybe you qualified, but you were sort of on the edge, just slightly in the neighborhood of qualifying, maybe you're getting 5 or 10% of the death benefit paid out to you. But as you're aging and you're getting to the point of families you're talking to that need care, and now they're just at the point of how do I pay for it? Well, they maybe are getting 30, 40, 50 cents on the dollar for their policies. The minimum size policy to do a life settlement is a $100,000 death benefit. 30, 40, 50 grand. That is then available to start paying for care, your services. Like I said, a life insurance policy is an asset. It is legally recognized as the same personal property ownership class as a home. And that's actually a nice way to compare it, right? You make mortgage payments on your home for years. One day when you're done living in that home, what do? Do you drop your keys in the driveway and abandon your home and walk off? No, you sell it. You sell it for its market value. It's the same thing with a life insurance policy. You make premium payments for years on a policy, yet too many people just abandon their policies. One day they're like, we don't need that anymore, stop paying the premiums. And then it's gone. Well, I can tell you the insurance companies love that. They're like, thank you for years of premium payments, and now you're gone, and I don't owe you anything in return. They love it. But for people who have the good fortune of being educated and informed and take advantage of this opportunity, if they qualify, again, older and sicker, there's a significant payout that they can access. And when you think about the assets that Americans own, your home and your life insurance are the two biggest asset classes in this country. Okay? 260 million life insurance policies with about $14 trillion of death benefit in them, pretty much on par with how much home equity there is across this entire country. You've got about the same asset pool that you can dip into, and there are methods in which to get the value out of that. Life settlements for life insurance policies, reverse mortgages for homes is one, which Tara will be talking about. So the LTC life settlement, we've had this in the market for almost 20 years. I brought this into the market after I left Washington, D.C., and I had worked for the industry. I saw this need to match the ability to cash out life insurance policies to the long-term care industry. And we've been an industry leader in this space ever since, working with groups like 21st and many others for years across the country. This is a way to create funds to pay for an immediate need for care. The process itself of doing one of these takes between 60 and 90 days from start to finish. And then that money is immediately available to start paying for care. All care is covered by this. Anything. There's no exclusions. Because the person is receiving a lump sum of money that they are then in charge of to distribute as they need to pay for their care. So you can do a number of things with it. You could do home improvements to help better set up a home to age in place. You could pay back family members that have been out of pocket helping to cover costs of care. And you can pay care at whatever level you need and whatever form of care you want going forward for as long as you have that money. Now, this is recognized as a Medicaid qualified spend down of the asset. Well, I have that effect on things. That's like, this is good. So funds paid towards care from liquidating a life insurance policy are recognized as a Medicaid qualified spend down. In doing this, that person is private pay, let's say for 2 years, and they spend all the money, then there's nothing in having done this that would impede their ability to go on to Medicaid. Medicaid wouldn't look at this and go, oh, you did that, now you can't go on. Which, if you don't get your spend down right, will happen. Managing your spend down inside of the spend down period is critical so that you don't end up penalized later by Medicaid for having taken money and gone on all kinds of world cruises and then spent all your money and then showed up and said, okay, I'm ready for my Medicaid now. They don't like that. Also, this is tax-free money. A person who does this and sells their policy with a need for care, 2 ADLs or more, it's tax-free. They don't have to pay any taxes on it. And again, this is keeping them private pay, extending the ability to be private pay, which I am telling you. You want to find as much private pay dollars in the market as you can find? The government wants you to find as much private pay dollars in the market as you can find. And they're going to make that more and more clear every day to everybody. The more you can build private pay into your business, the better your business is going to do. And the more you take advantage of these kinds of tools, the better you're going to do. And guess what? This is free. Okay? This is free. We don't charge you anything to use our services, and there's no charges to the consumer to do this. And I'll explain that more. So who qualifies for this? Well, again, why am I here talking to you? Because we are all talking to the same people. The people who qualify for a life settlement are the people who need your services. The older and sicker you are, the better you're going to do. And I know I'll get a call from somebody this week in this thing, and they'll be, hey, I've got a friend, he's 45, he's a marathon runner, and he's got a policy, he doesn't want to carry anymore. How much can he get? Nothing. Did you not listen? How many times? What was the guy that with the interference? That's the one who didn't hear it. So typically it's going to be somebody who's 65 and above. The minimum death benefit size is $100,000 and above. A smaller policy, $10,000, $15,000, $20,000, those are typically final expense policies. And we always recommend for families to hang on to those. Don't let those go, because when the time for final expense payments comes, having that is a huge relief. Having some money to be able to give somebody the proper send-off, burial, everything is help maybe some family members come in and be able to be there. You want that. And those policies are just too small. But $100,000 and above, now that's a policy that would be big enough. And it's any kind of life insurance policy. A term life policy, a universal life policy, a whole life policy, a group life policy. Any kind of life insurance policy is going to qualify. And there's no costs whatsoever. There are no out-of-pocket fees. You're not paying any interest because, remember, you're selling. Like, think of it, again, just like selling a home. When you sell a home, do you pay a realtor money up front? No, it's commission, right? Do you owe interest on the sale of your home? No, you've sold the asset. That's your money, free and clear, and you're done. It's the exact same thing here. So what's the process? Let me emphasize so much to you, we don't want you to be an expert in this. We don't want you to feel like you need to be an expert in this. Okay? All you need to do is just make sure that you're letting families know. And there's a couple ways to do this. You could ask them, or you could just inform them. You could say, hey, you know what, by the way, if you have a life insurance policy, if you're a veteran, if you own your home, I don't know if you have long-term care insurance, I don't know if you have annuities, but there's a bunch of ways to use those things to pay for care. If any of those sound like that would work for you, we have information, we have partners that we work with that can help you access that and do that. Okay, that's all you got to do. It's just, we will do 99% of the work, but we can't do it unless you do 1% of the work, and that's letting somebody know. And then all you need to do is let us know that a family member, that somebody you're talking to, they have a life insurance policy, and can you talk to them? We have videos. We have print materials. We have all kinds of great stuff that you can give a family. We have great, easy to follow animated videos that will help a family understand how this works. A couple of minutes, they watch it, and you refer them to us. We take it all from there, but we're working with you. My people who've been doing this for years know that once they're talking to a family that you've sent over, they're now an extension of your office. They're working for you to get the family through. You're going to get weekly updates on, okay, here's what's going on with the family, here's what's going on with the latest. They may be calling you to say, you know what, the family's gone MIA. We haven't heard from them in 2 weeks. And we're in the middle of this thing. Can you reach out? Can you help us? Can you, but we're doing the work. We may need to mostly we're keeping you informed. Once in a while we may ask you to, can you nudge the family and keep them moving forward or figure out what's going on? And what we're going to do is give them a no cost, no obligation policy review. We're going to look at our people are going to look at their policy. We're going to look at some of their health background to figure out, do they qualify and how much could they get? How much would we be able to pay them out for a life settlement? So what you need to remember about this portion of the 3 financial options, and there's others again, annuities you can work with, long-term care insurance you can work with. Obviously, people who have money saved and invested, if they have the ability to start paying the monthly fees, but you want to make sure that they understand there's a whole range of options here to help you do this. You don't want to have them walk away going, Well, that all sounded great, and it all sounded expensive, and I have no idea how do I pay for this, and so I'm moving on. You let people walk away without a full understanding of here are your options to pay for this, and we can help you with all these. That's going to differentiate you from your competitors. It's going to keep you in these people's orbit and working with them, or else all you're going to do is give them some stuff and they're going to move on and keep shopping and shopping until someone else does this for them. And then you're going to lose them and someone else is going to win. So remember, this is for seniors. The older and sicker, the more they get. This is a way to turn a life insurance policy into paying for long-term care. It's the legal right of the policy owner to do this. There's no costs. Tax advantages. If they need long-term care, they're going to get this tax-free. A Medicaid qualified spend down, and it takes about 60 to 90 days to get it done. And when I say no cost, again, let me emphasize, no cost for you as well. We have a full toolkit, videos, materials. If you wanted to get ambitious and use some of things like this to start getting it out on social media, get some things up on your website, put a funding options piece on your website, we have everything you need to do that. Everything you need to do that. Turnkey. Again, I'm Chris Orestis, the president of Retirement Genius. We've been doing this for 20 years, and we have paid out millions of dollars through this to help people fund their care. Home care, assisted living, every form of care, and a lot of this we do in this home care arena. There's my contact information. I have business cards out on the front table as well, but a dwindling supply. Now I'm going to stand in for a dear colleague of ours who couldn't be here today, who is a specialist in the VA aid and attendance benefit. Now here's another way for you to help people pay for care. I'm going to go through how this works, who's eligible, what specific amounts are paid out for care in 2025, and give you a sense of the size of this market. Where do you find veterans? The answer is pretty much everywhere. So aid and attendance is a benefit program that's paid to veterans and their spouses. And it's unique in that there's certain veteran benefits that will only pay to the veteran, certain benefits that will work in just reimbursing specific care at VA-approved centers, things like that. This is different. This will actually pay just a lump sum amount towards care on a monthly basis, covering the veteran and or their spouse. The VA itself, you've got the VA Healthcare Association, you've got the VA benefit area, and then you've got the cemeteries. Well, let's forget about the cemeteries. That would be too late for us. So the VA provides health care. It's like, think of it like hospital, right? You know, hospital-based, facility-based care. To be able to get funding, you have to be an approved agency for here, and it's only for the veteran themselves. But over in the veterans benefit area, the VBA, this provides finances for home-based care. Your agency doesn't need to be approved by the VA. So you can, if your client is a veteran and they have qualified to get the VA aid and attendance benefit, they can use that to start paying for your care. You don't have to go through any loopholes and paperwork with the Veterans Administration yourself. And again, this will cover veterans and or surviving spouses. To qualify for the veteran, just so you know, again, we don't want you to be an expert in this, but we want you to know enough to be able to say, hey, we've got some options here, okay? And let me give you some stuff that you can look at, and if any of these work for you, and by the way, it doesn't have to be just one, you can combine these. If somebody has a life insurance policy, and they're a veteran, and they have long-term care insurance, and they have an annuity, and they own their home, they could do all five. They could do all five at the same time. Or space it out, like, well, I'll start with this one, and then when I run out of that one, I'm going to go to this one, and make sure now I know I've got enough money to cover me for the next X number of years. For a veteran to qualify, they would need to have been honorably discharged with a minimum of 90 days served in the military, with 1 day served during an active period of war. Well, remember, this is United States of America, so pretty much we're always in an active period of war. So don't worry about that one. Everybody qualifies, pretty much. They have to have need for care to qualify. It's not something you would qualify for in advance and then sit on it and wait till you need it. It's when you need care. Just like the life insurance thing. You know, you need to be, it's not like, well, I'm young and healthy now, so why don't I do that in case I need it in 10 years? It's when you need it. If you're healthy and you think you need something in 10 years, that's when you need to buy a long-term care insurance policy. It will cover the veteran, their spouse together, or if the veteran's dead, the spouse can still be covered. So that's important to find out. Not only asking the question, are you a veteran? It's, are you or your spouse a veteran? Because then they can qualify. And there is, you can't, not anybody can qualify this in terms of if you're too rich. Elon Musk is not going to qualify for this. He's too rich. But most of the people you're talking to, they're going to probably qualify based on their net worth. And this is what the payouts are. In 2025, here's the payouts. So just the surviving spouse alone, $1,500 a month. Just the veteran by themselves, almost $2,400 a month. The two of them together, almost $2,800 a month. And jackpot, two veterans married and together and needing care, almost $3,800 a month in veterans benefits paid every month to you for providing those care services without you having to deal with the VA itself. You're just, they're getting that benefit and it can be paid to you. So where are you going to find veterans? They're everywhere. Here's an example just of Florida, okay? This is here not just because we're in Florida, but just this is a good example. And this goes back actually now. This is 2023. But you've got almost 730,000 veterans in this state who, based on their age, their period of service, could qualify for the VA aid and attendance benefit. But as of that date, you had less than 19,000 that were accessing it. Big gap there. Just like with life insurance, right? There's 260 million life insurance policies out there. And seniors on an annual basis in this country own $200 billion of death benefit that could qualify. And every year there's about $4.5 billion worth that gets done. So many people have access to these. And when you see the reverse mortgage numbers, it's the same thing. Huge accessibility, huge asset pool. And just not enough people know and go forward and end up sacrificing and end up getting less than they should and not getting the care they should, not living at the level of dignity and control. Because remember this about private pay and the difference between it and Medicaid. Okay? Medicaid means you are below the poverty line. Medicaid is a program for the poor and disabled. Okay? Now, it's also the default payer of long-term care in this country because seniors go through, quite frankly, a very undignified process of spending down to get poor and get below the poverty line so that they can then go on to Medicaid. Well, be careful what you wish for, people. Congratulations, now you're on Medicaid. And guess what that means? You're no longer in charge. You're no longer in control. You can't dictate. Medicaid says to you, okay, well, here's the 3 nursing homes in your region you qualify for. You can go to one of these, maybe only 1 or 2 or 3. We'll see what's available. You're sharing a room with 1 or 2 other people. You're not getting a private room. You're not going to an assisted living community where they're having cocktail parties and barbecues. Medicaid, you're not on the lobster plan with Medicaid. You're on the oatmeal and applesauce plan. Okay? Sorry. It's true. Private pay? Hey, I'll hook you up with lobsters. I know where they are. You can afford them with private pay. I know where to find them. I'll show you pictures at lunch of like one of my sons in the summer. He comes home from college, he lobsters. Makes a killing. But look at the size of this market versus how many are, and it's up to you to tell people. If you're a veteran or your spouse was a veteran, we have an option. That's Carmen's contact information on VA stuff, but you can contact me directly as well, and I'll help you with that. Now, it's my pleasure to pass the baton over to Tara Ballman, who is with Longbridge Financial, one of the leading reverse mortgage companies in America. Also, she's the executive director of the National Aging in Place Council, the NAIPC, a leading trade group representing the world that you are all entering. Tara, come on up and take it from here.
Thank you, Chris. So as he mentioned, I'm Tara Ballman. I've spent the last 19 years in the Aging in Place space as a member of the National Aging in Place Council, and the last 5 years really managing the organization. My experience, I started in this world in the reverse mortgage field, and then I took a little bit of a turn.
My phone isn't on.
It's not on?
No.
Ah, now it's on. Okay. Thank you, sir. Thank you. So I have a little bit of experience as well in other areas. My husband and I have a PT/OT company in Orange County, California, where we do outpatient services in the home. So in addition to my reverse mortgage experience, I have experience with Medicare billing, which is always fun, home modifications, hospice, healthcare. And then I brought all of that back together to come back to Longbridge Financial, where I've been for about a year. So I brought all of the experience over the last 19 years to help create an aging in place business channel. We're actually the only lender in the space who has an aging in place channel. So if you send us one of your clients and we're not able to help them, we're not just going to say, sorry, goodbye, good luck. We have identified at NAIPC over 72 different service sectors within the aging in place marketplace. So we go back to our network and make sure that we find a way to help your clients in housing, healthcare, finance, transportation, and social engagement issues. I also have written 5 books, 5 published books. 3 of those are on reverse mortgages. 2 of those are on difficult aging in place conversations. We have a new book coming out in October that is the Caregivers Edition. So that might be of interest to all of you in the audience. Stay tuned. It will be available on Amazon. So just curious if anyone in the room has not heard of a reverse mortgage. Okay, good. So you all have a basic understanding of what it is. That's great. Hopefully you'll leave here today with some new ideas on how to use an old product. So the basic qualifications, you do have to be age 62 or older for what they can call the home equity conversion mortgage, which is the FHA mortgage. The very, very bad industry joke is it's a heck-em of a loan. Oh, thank you for the polite chuckles. Thank you, thank you. I got to stop using that joke. And then Longbridge has its own proprietary reverse mortgage. We call it the Platinum product, and that's more for the jumbo loans that go over the amount that you qualify with for FHA. So just like a traditional mortgage, you have to maintain your home. You have to pay you have to meet your loan obligations, keeping your property taxes paid, your home insurance paid, and keeping the home and maintained. But the difference between us and a traditional mortgage is you don't have to make monthly repayments. You can if you wish. A lot of older homeowners are trying to preserve equity in their home for their heirs or the estate, but it's not necessary. So if an event does arise where you need extra cash, the homeowner always has that in their pocket. And one of the big misconceptions out there is that the bank takes the home when the homeowner passes away. Has anybody heard that? That is not true. The homeowner will keep the title, keep control of the property. So when the homeowner passes away or moves, you sell the home. You pay off what's left, and then the estate or the heirs gets to keep the remaining funds. And the best thing about a reverse mortgage is that it's a non-recourse loan. So if the home is valued at $500,000, but the older adult owes $800,000, the mortgage insurance kicks in, and there's no debt passed along to the family. So there are different ways that folks can access their home equity using a reverse mortgage. One is a lump sum. So all of the funds that are available, they can take out in one big swoop. Now, we do make sure that we are lending responsibly to older adults, so we make everyone go through a financial assessment. There's a tool that everyone must go through, and mandatory HUD counseling. It's through a third party that we are not related to in any way. So they're really making sure that we're not just giving chunks of money for people to spend, and then they're in a worse position than they were before they took the reverse mortgage. You can also get fixed monthly advances, and that will come until the last surviving borrower leaves the property, which is great for paying for home care costs and for your clients to utilize. And then there's a growing line of credit, which I'll talk about on the next few slides in a little bit more detail, because I think this is particularly of interest for the folks that you are serving, and for you to know how to afford that long-term care going forward. And you can have a combination of those. So if, say, a homeowner needs to make modifications, they're having a surgery, and they can't access their home, and they end up going to a skilled nursing facility because it's not safe in their home. So you can get a lump sum to make those changes. Just think about your own home. How do you even get in the door? Is your driveway sloped? Do you have to walk upstairs? Are your doors large enough? Is there a threshold? And that's just getting from the driveway into the house. So a lot of folks are using reverse mortgage funds to make those home modifications pre-surgery so they can come home faster. And then they're using the fixed monthly advances on an ongoing basis to get their care brought to them in their home. And then they set up a line of credit as well, which is a growing line of credit. And then I also have a slide I'll talk about a little bit. It's a new feature of people using a reverse mortgage to purchase a home. They used to say downsizing, now we say right sizing, but it could be for getting a larger home as well if you want to have a multi-generational house where you have your family come in and the families are caring for the older adults. So reverse mortgage funds can really be used in any manner that the homeowner wishes. So the top two reasons are to pay for care in the home, private pay and home care, and also the home accessibility and home modifications. But anything they'd like to use it for, they are certainly able to do so. So I'll talk a little bit about the reverse line of credit. I think the first two options I mentioned are a little self-explanatory, the lump sum payment and the monthly advances. But a reverse line of credit is very, very similar to a HELOC, a home equity line of credit, which most people are familiar with, where you take out the equity and then you have to make the monthly repayments. But with a RELOC, you don't have to make those monthly repayments unless you don't want to. And the amount that you have in the line of credit is actually growing every month. So when let's say someone age 62 takes out a reverse mortgage, we'll probably loan, I'm not a loan officer, I don't run numbers every day, but let's say they get 60% of the value of their home. So over the course of time, as they age, they'll have access to that 40% that they did not have access to previously. And I like to say that it's access to the home equity. It's not earning money. It's not an investment tool. It's just allowing them more access to that equity they already have. And it's also open-ended credit. So if they needed, like pre-surgery, they wanted to take some funds out, they could take the funds out, pay it back at their leisure, and then if they needed more funds in the future, they could again withdraw that money. So it's a very good use of a cash flow management tool. You just have to make sure that the older adult doesn't completely pay the loan off because that's considered a maturity event. So another great benefit is that it's liquid equity. So at any point when the older adult needs the funds, they can call our servicing center and access that immediately. And another good thing, another good differentiator between a RELOC and a HELOC is that our loans aren't frozen. So you all probably saw the fires in California where many people lost their homes. If they had a HELOC, those were instantly frozen. A RELOC, they still had access to their home. So they could use those funds, even though their home was not necessarily there anymore, they could use those funds to rebuild their home or continue care in another location and continue to pay for their prescriptions. And then also our funds aren't taxed. When you get a reverse mortgage, the funds are not an income taxable event. But I would warn you that if you have clients that are need-based on need-based programs, the way that they receive their funds could possibly affect some of those benefits. So we'll need to be extra careful in those situations. But that's why we have the counseling, to make sure that we address that before they get themselves in trouble. And then the line of credit growth, it's not accrued interest. So if they take out the loan, you know, the lump sum amount and the closing cost, that is what's accruing interest. The amount that goes into the line of credit that's growing is not accruing interest until they actually take that out. And the amount that it's growing is the same rate as the interest that's being charged on the outstanding amount. Okay, so this is just an example of how a line of credit can grow with a home equity conversion mortgage. So all the little fine print there, that's what the legal and marketing and compliance department makes me add. But in this example, the youngest borrower is age 62. It's a home located in Massachusetts worth $800,000. And this is an example of when there were no draws taken out of the line of credit. So you can see the growth rate if it was established, where it is after 20 and 30 years. And let's say at year 19, the senior pulls out $900,000 of their mortgage, of the reverse mortgage line of credit, to maybe put in an accessory dwelling unit, to have the caregiver of a family member move in. And then they pass away at year 20. So they owe maybe $900,000 on the loan, but the home value is $800,000. That's where that mortgage insurance kicks in, where the estate won't be responsible for the difference. And then this might be getting a little bit too far into the weeds, but this is one of my favorite charts because a lot of people associate reverse mortgages as a need-based product. So the example on the left, the chart on the left, I know it's a little blurry, I can share this with anyone that's interested. This is showing you using all of your investment, all of your liquid resources, draining down your finances, and then taking a reverse mortgage as a last resort. The chart on the right is showing people using their investment savings during up markets. And during down markets, they're not touching those funds, and they're pulling from their line of credit. And look at the difference of the value, $933,000 difference, by using it as a financial management tool instead of a last resort tool. And here's a quick example. This is my last example, and then we'll open it up for questions if we have time. But this is using a reverse for purchase. And this is the one that would be very beneficial for those of you in the room who just to have this information. So the youngest borrower in this example is 70 years old. It's a Florida home valued at $500,000. And I'll use a fourplex as an example. So they're right sizing. They are purchasing the fourplex. One of those units is completely remodeled, ADA compliant, an aging in place forever home. The second unit could be used for a living caregiver or for a family member who's coming in to care for the older adult when your caregivers aren't able to be there. The other two units, they're renting out. So in this example, the green chart is showing the value of the home increasing with appreciation. The blue line is the loan balance over time. The yellow line is that older adult taking their rent payments, putting it into a line of credit, paying $1,000 a month, so that if there's a situation in the future, a disaster, a medical situation, they take a tumble, they need extra help, they have the ability to access those funds to pay for that, where they wouldn't necessarily have it before. So it's a good little emergency backup plan using a reverse for purchase in a new and different way. So that's all I have for you today. I know those were kind of examples that I threw a lot at you right there, but again, like Chris said, we don't expect you to be the expert, so please feel free to contact me anytime.